Please do not become a little when the market dumps 2% in one day and you automatically sell. That is classic retail mentality, and Wall Street thrives on that. I'm Erin Chavla with Trader Foundation Elite Academy. Let's get through how to build wealth and how market crashes are our best ways to create that. If we're analyzing overall wealth building, we need to take a look at the weekly chart, which is what I have right now, and this is for the SPY. Right now, we broke down, and today it's after hours, but it's Wednesday, January 21st, 2026, and the market closed. We had a pretty volatile market in general because of the EU, the tariffs, and then there was a massive flip today, and now we're green. The last correction that we had was actually back in April 2025, Liberation Day, and we dumped, it was like 18% exactly, I believe, from all the way from top to bottom, right? And just imagine if you could go back in time and be like, I wish I shoulda, coulda. A lot of people probably had diamond hands because all the headlines were like, oh my gosh, we could go lower and everything like that, right? And that's the thing. If you continue to, act like retail, you're gonna just be sitting on your hands the whole time and never do anything. Imagine if you seize on that opportunity, right? This is where real money is made. So from the peak down all the way up to present day, it's up about 21%, I believe, as of today. 21%. Of a move, okay? The biggest bear market that we had was 2020 of our generation. We dropped 34% from top to bottom. And this is even if you didn't catch the low. And it recovered in 33 days. And this is the thing. The best way to create wealth generation is if you're able to take in the fact and stomach red. You have to have steel. I will definitely say that. Like, it sucks stomaching the red, but you just it up and you go forward, okay? 2008, we dropped, I believe it was 37% from top to bottom. And it took about a year for us to recover a bit. But imagine if you started buying at every single 10% drop. Your cost average basis would be significantly better. And now look at the SPY where it is present day, 685. It has, at this point, 5x, okay? I'm just doing simple math right now. But this is the part where compounding comes in. Full circle. Like, yes, you had to wait time, but you're not going to be able to get any kind of return anywhere else. I'll tell you a funny story. I don't know if it's funny, but it's more so like, wow, I really screwed myself over on that one. Back in 2020, I thought I was the coolest thing because I bought Google in 2020, okay? And I remember I bought some shares, and this was pre-stock split, okay? So it was about $1,000 a share. And I thought I was super cool because I was like, oh, wow, I got a 50% return. And I'm like, I'm awesome, right? To give you perspective, for Google, $20,000 worth of shares if you bought in the 2020 lows, it's equivalent to $131,000 today. Because not only that, they had a stock split later on. So your 20 shares, let's just say you had 20 shares, it would have turned into 400 shares. And it's $131,000 on your $20,000 investment. That is compounding at its finest. I believe it's a 553% return. You're not going to get there anywhere. And that is only on your $20,000 investment. Messed that one up because I sold and I thought I was the coolest thing on earth. Just think about if you add it on, you keep on holding it. And think about this now. I bought Google last year, February, March, April. Google in 10, 20 years, I bet you they're going to have another stock split. The investment that I have initially right now, it's going to be, I think, similar. So let's say you 20,000, then it's 100, and then 200. But that's how compounding works. And this is where real money is made. This account that I manage, I've had this for several years. It's kind of went through my trading journey. Okay, this year alone, I'm up close to 80%. And basically, the biggest thing that I want to go over is Google, for instance, as the one I was telling you guys about. In general, I did not catch the lows. I saw fair value and I was willing to stomach it, and I stomached a lot of red, but I was like, I'm gonna stick into it because I know as it goes lower, I see perceived value into it. And there's a lot of the reasons as to why I believed in it and whatnot, cash flows associated with Google and etc. But as you can see, this is just one of my investments, right? I have several positions that some of them are in the red, but that's okay. To contrast, another account that I just opened, it's actually down quite a bit since I opened it, but compounding hasn't actually happened yet at this point because it's only been open since October. And so this is the one thing that I really want to showcase is that compounding, it takes time for it to start working. The first few years, not gonna lie, it's annoying. It's I'm not really seeing the value of it, but then all of a sudden, it really starts showing up. And that's when you're like, oh, this stuff works. If you want to build generational wealth, please join us at Trader Foundation Elite Academy, and don't forget to like and subscribe to this channel. See you guys there.